The Kenyan banking sector registered improved performance with the size of assets standing at 2.4 trillion shillings, loans and advances amounting to 1.4 trillion shillings. While the East African nation's banking industry experienced growth in all its sectors, that includes loans and advances as well as assets base and deposits during the quarter in review. Well, for analysis on all of this on the banking sector, we are joined by George Bodo, who's the head of financials desk at Ecobank. George, thank you so much for making the time to join us today. As you heard in that intro, we have seen an improvement in the banking sector if you're looking at it on a year-on-year basis. But quarter-on-quarter, if you're looking at these earnings, not so good. We're seeing that they have come down. What's your take on this?
Thank you. Generally, the banking sector on a quarter-on-quarter basis, the performance has come down. And I mean, if you're looking at the listed banks, which at the end of quarter three represent about 76% of the banking sector, if you look at the top line, if you start with the interest income, the funded income segment of the interest income, and if you look at it, it was down 1%, non-interest income was down 5%, operating income was down 6%. I mean, it's only cost that went up. And if you drop down at the bottom line, net earnings for the 10 banks was down in excess of 20%. So on a quarter-on-quarter basis, there was a bit of stress in the banking sector. And actually, if you look at some of these results, it just shows you that there was no exceptional performance, actually, in terms of booking assets. Yeah.
So, you mentioned the stress that has been experienced by the banking sector. What has been driving this? What's behind this?
I think generally there's a slowdown in private sector credit uptake, and if you look at the numbers, I think you're still below the 20% target of the central bank. And so that's even if you look at the monetary policy environment right now, it's a bit accommodative. This is because the rate of money creation, the credit money creation process, the momentum is really slow. And this defies what the central bank, the central bank's quarter three survey, credit officer survey report, which shows that there's a general optimism, which was not even there. If you look at quarter three, and especially if you delve into the numbers. So our view is that if you look at this performance, if it's extrapolated in quarter four, then the performance in 2012 may not be replicated, especially if you look at the return on assets, return on equity. At the end of quarter three, we were about 27% annualized, and last year we were doing 31%, so we might not realize this. And this performance actually, it boils down to the fact that most of the assets were non-performing, especially in quarter three. And I can tell you that if you look at the quarter-on-quarter growth, really not even quarter-on-quarter, on a YTD basis, earning assets were up 6%, but non-performing assets, non-performing loans were up at 9%. So banks are dealing with non-performing assets,
Yeah, George, let's talk about that, because that seems to be a trend that's starting to become a bit worrisome when it comes to the non-performing assets.
Yes, I mean, I was here some time back and I said that, at that point, we'll look at the big names such as KCB and Equity, which actually continue to dominate the non-performing loans in this sector. They actually account above excess of 50% of the listed banks' total portfolio. And so these guys are the ones who are driving this performance. And what I would want to say is that there's a general loophole in terms of regulation in this country, and to the extent that you can restructure a non-performing loan as much as you want. So what's happening is that some of these non-performing loans, they're not new, they're not brand new. These are loans that date back to a point when the macro fundamentals of this country declined substantially, when you're having inflation, double-digit figures. That was quarter three, quarter four, 2011, and into the first half of 2012. So what you're seeing is gradual classification and suspension of interest on some of these assets, some of these customers, sorry.
So how can we set it right? Because you said it dates back, from around 2008, if I'm not mistaken. How would we set it right?
I think the best thing is that the regulator needs to crack the whip here, and I think it's doing that saliently a bit. These things they need to be classified, they need to suspend the interest, they need to fully provide for them. In cases where they're really lossful, they need to liquidate the collateral, and clean up the books. Because what you're seeing is that, in our view, is that the current NPL portfolio should actually be double what they are. We are not convinced that there's been a full classification and full provision. So I think going forward, and as the regulator piles on pressure in quarter four, we might see more of these non-performing assets being unearthed. You know.
George, let's talk about that sort of impact that we've seen these earnings have on the stock market. I mean, how have they influenced the local bourse?
It's amazing the market valuations are not pricing this, surprisingly, you know. If you look at the price to book value, average price to book value of the listed bank, the banking sector stocks, at the end of quarter two, it was 1.8. We are now talking about 2.1 at the close of quarter three. You know, really, it begins, you know, we begin to question in the market's valuation paradigm. But I don't know, maybe they are factoring the fact that we still have the most profitable banking sector in this region. You know, Kenya's banking sector was the top globally in terms of return on assets, according to data compiled by the banker. I think maybe they're thinking there's a real hope. But I think going forward, if these numbers continue to sustain at this moment, I think they have to knock off some discount on the valuations. And I think it's not justified. The current valuations are not justified.
As you mentioned, going forward, we could possibly see some stress still in the fourth quarter. Are you able to maybe tell us what sort of numbers we can expect?
Fourth quarter generally a very slow quarter for the banking sector from an asset creation perspective, and we do not expect even a 5% quarter-on-quarter growth in terms of assets, because if you look at quarter three, the momentum should have been built there, but quarter three itself was very slow. So if you extrapolate quarter three and quarter four, we might even have no asset growth at all, you know.
Georgia, we've seen quite a budding gas sector in Kenya at the moment. To what extent has the banking sector been involved when it comes to perhaps financing these projects, or even looking at renewable energy? Are they at all involved with this?
I'll tell you what, in terms of the balance sheet capacity, it's still not there. The biggest banks that can handle a transaction in Kenya is KCB, which has an SOL of $100 million. I don't think that any single bank in this town can handle a transaction as big as $500 million, a transaction going as big as $1 billion. No, we can't, unless they combine. So that's why going with what we've seen in this market is banks handling transactions below $100 million. So you're talking about wind power project, the latest one being Barclays financing a wind power project with a tune of $30 million. You know, transactions below $100 million. But when you go above more serious transaction and you talk about upstream activity, the discovery of oil in the northern part of the country, talk about very big power projects, we can't handle that. We don't have the balance sheet capacity unless there's a consolidation here, because I'm telling you, there's no balance sheet strength, there is no pricing advantage. I mean, Nigerian banks will actually beat us in taking up this transaction.
George, thank you so much for that insight. That was George Bodo, who's the head of financials desk at EcoBank.